I'm Benjamin. Have you ever looked at your retirement accounts, made a calculated withdrawal, and then experienced a moment of total shock when tax season arrived? Suppose you pulled $20,000 from your 401k or traditional IRA, just $20,000. So, why is the IRS taxing you as if you withdrew $37,000? Let me speak plainly, friend. This massive gap is neither a system error nor a coincidence. It is an invisible, mathematically brutal tax trap designed into the tax code that catches thousands of retirees off guard every single year. And here is the part that should make you sit up straight and pay close attention. Falling into this trap has almost nothing to do with how much money you have saved. It has everything to do with the exact order you turn your retirement income streams on. You could have done everything right for 30 or 40 years. You could have lived below your means, paid off your mortgage early, avoided bad debt, and invested faithfully every single month. Yet, despite doing everything by the book, you can still walk straight into this trap simply because you flipped the wrong financial switch first. Get that sequence wrong, and you end up handing over tens of thousands of dollars to the government that you never had to part with. When you reach retirement, you are typically sitting on 3 different income buckets waiting to pay you. Bucket number 1 is your 401k or traditional IRA. Bucket number 2 is your Social Security benefit. And bucket number 3, for some of you, is a traditional company pension. From the outside, all 3 feel like standard dependable income. They all deposit cash into your checking account, and they all help pay your monthly bills. However, the reality is that these 3 buckets do not play by the same rules, not even close. One of them you control completely. One of them you can intentionally speed up or slow down to maximize its value. And one of them turns on automatically at a fixed age whether you like it or not. When you draw from these buckets in the wrong sequence, the tax systems begin working directly against each other. That is exactly where good, hard-working people get burned. Not because they failed to build wealth, but because nobody ever taught them that the order of withdrawals matters just as much as the amount saved. Let us lay these 3 buckets on the table and look at the mechanics. Bucket number 1, your traditional 401k or IRA. Every single dollar you pull from this bucket is taxed as ordinary income, just like a paycheck from your former job. That is because when you contributed that money years ago, you received a tax deduction and paid 0 tax on it going in. The positive side is that this bucket is your most flexible financial lever. Once you pass age 59 and a half, you decide exactly when to withdraw, how much to take, and when to stop. Required minimum distributions, known as RMDs, do not legally force your hand until age 73. Now look at bucket number 2, your Social Security benefit. You can technically switch it on as early as age 62, but doing so locks in a permanent lifetime benefit cut of roughly 30%. If you wait until age 70, your check compounds by roughly 8% for every single year you delay. That means claiming at age 70 gives you a monthly payout roughly 77% higher than claiming at 62. Now, here is the critical rule that most retirees never realize until it is too late. Social Security is not taxed based on how large your benefit check is. It is your other outside income that determines how much of your Social Security gets taxed. Let that sink in for a moment. Your other income decides. Bucket number 3 is your pension. Fewer people have pensions today, but if you do, it is usually a fixed monthly check that switches on automatically when you retire or reach age 65. You rarely have the ability to delay it, and it is fully taxable as ordinary income. Therefore, a pension quietly fills up the bottom layer of your taxable income floor before you even touch a single dollar from your other accounts. So, what do most good, cautious people do when they retire? They follow the sequence that feels the safest and most intuitive. They claim Social Security early because it feels guaranteed and tangible. They let their 401k sit untouched because financial culture taught them never to tap retirement savings until absolutely necessary. And their pension simply turns on whenever the company mandates it. It sounds responsible, disciplined, and safe, does it not? And here is the uncomfortable truth. That safe-sounding order is the exact trigger that springs 3 massive tax traps. Trap number 1 is the most destructive. I call it the Social Security Tax Torpedo. The IRS calculates a specific metric called your combined income. Your combined income is your adjusted gross income, plus any tax-exempt interest, plus exactly half of your total annual Social Security benefit. As that number climbs past specific legislative thresholds, more and more of your Social Security is dragged directly onto your tax return. For a married couple filing jointly, once your combined income passes just $32,000, up to 50% of your Social Security benefit becomes taxable. Once you pass $44,000, up to 85% of your benefit can be taxed. For single filers, those frozen lines sit at just $25,000 and $34,000. Now, listen carefully to this historical reality. Those income thresholds were established back in 1983, and Congress has never adjusted them for inflation, not once in over 40 years. While the cost of living, housing, food, and healthcare soared, those tax thresholds remained completely frozen in time. Let me show you what this means in practice. Imagine a married couple whose combined income sits right at $43,000, just under the upper line. They decide to withdraw an extra $2,000 from their 401k to take a family trip. That $2,000 withdrawal pushes their combined income over the threshold, which suddenly causes approximately $1,700 of their previously untaxed Social Security to become taxable. So, while they physically withdrew only $2,000, they generated $3,700 of new taxable income. In the 22% tax bracket, that modest vacation withdrawal triggers over $800 in actual taxes, creating an effective marginal tax rate north of 40% on their own money. That brings us to trap number 2, which is particularly dangerous because it operates on a 2-year delay. It is called Medicare IRMAA, or the Income-Related Monthly Adjustment Amount. In plain English, if your modified adjusted gross income climbs too high, your Medicare Part B and Part D premiums spike significantly. The twist is that IRMAA looks back at your tax return from 2 years prior. Your Medicare premiums in 2026 are calculated entirely from what you reported on your tax return in 2024. For 2026, the initial surcharge threshold sits at $109,000 for individual filers and $218,000 for married couples. if you cross that threshold by a single dollar, you trigger an automatic monthly surcharge that can easily cost a married couple over $2,000 a year in unnecessary healthcare costs. Then there is the third trap, which impacts higher balances, the net investment income tax. If your income spikes past $200,000 for singles or $250,000 for couples, an extra 3.8% surtax applies to investment earnings. This proves why an uncoordinated withdrawal can set off a cascade of unintended taxes across multiple agencies. This brings us back to our core puzzle. How does a $20,000 withdrawal look like $37,000 to the IRS? It is because that withdrawal pulls $17,000 of Social Security benefits out of tax exemption and forces it onto the tax return alongside the $20,000. $20,000 plus $17,000 equals $37,000 of phantom taxable income, money you pay taxes on, even though it never represented new cash in your pocket. So, how do we flip the script and neutralize these traps entirely? The strategic solution is counterintuitive to standard advice. In the initial years immediately following retirement, before you claim Social Security, you live intentionally on your taxable brokerage assets and planned 401k withdrawals. Why? Because any dollar you withdraw from a 401k before activating Social Security cannot trigger the tax torpedo. There is zero Social Security income for the IRS to drag into the tax net. These low-income gap years are your golden opportunity for strategic Roth conversions. By converting traditional funds at lower tax brackets while the traps are dormant, that money grows tax-free and stays completely invisible to combined income, or IRMAA thresholds later. Take Tom, who retires at 62 before his pension starts at 65. For 3 years, he lives on taxable cash and aggressively converts traditional IRA funds into a Roth. When his pension kicks in at 65, he scales back conversions, and at 70, he claims maximum Social Security. Because he shrank his traditional balance early, his required withdrawals at 73 remain tiny, letting him bypass both the tax torpedo and Medicare surcharges. Tom didn't earn more than his peers. He simply claimed in a smarter order. Your roadmap comes down to 3 clear steps. First, determine your baseline pension floor. Second, delay Social Security toward age 70 if resources allow. And third, manage your tax brackets to prevent accidental income spikes. True wealth management is about minimizing lifetime taxes so you keep what you earned. Calculate your real combined income this week and take control of your withdrawal sequence.
Thank you for watching. Don't forget to subscribe to my channel for all finance-related information.